You're not going to want to miss this. What I'm about to show you is how you can tackle a range-bound market. As you may or may not know, the Forex markets are often ranging a lot more than they are trending. So what strategy can you apply? What indicator can we use on our chart to tackle this market? So the indicator that we're about to add to our chart was made by a renowned trader known as John Bollinger. You may already guess the indicator, it's Bollinger Bands. John Bollinger made Bollinger Bands in the 1980s. Bollinger Bands was initially created to help traders to be able to identify volatility initially in stocks. As time has gone on, traders have adapted this to be able to utilize it within the foreign exchange market. The concept combines a moving average with a measure of volatility. It consists of a moving average, which is the middle band. Then it consists of two other bands, a lower band and an upper band. Bollinger's development of this tool was based on the observation that volatility was dynamic, contrasting with the then common belief that the market was static. The bands are used as a volatility indicator that measure the highs and lows of a security's price in relation to the previous trade. With the volatility is then measured as standard deviation, which adjusts as volatility either increases or decreases. This is what gives us our price movement on the upper and lower bands. Okay, so I think let's add this to our charts now and see exactly how the Bollinger Bands adds up on our charts, and also what chart do we apply Bollinger Bands to. So when we go to add Bollinger Bands onto our charts, what we want to do is we want to look for a currency pair that is very renowned for being range bound. Prime example are pairs that are highly correlated, such as Aussie against the US dollar and New Zealand against the US dollar. Both Australia and New Zealand's economies are very closely tied. So if we trade the Australian dollar against the New Zealand dollar, we'll find that the market is very choppy. Other pairs that you could find like this would be stuff like Euro against the Swiss franc as well, because that's very range bound, and also Euro against the pound. So ideally, we're going to just add that to our chart, which you can see on here now, which is the Australian dollar against the New Zealand dollar. Now we're looking at a daily time frame here. You can see how the market is very much moving sideways, and on a day-to-day basis, it is very much range bound, meaning that overall in the market, we can see that price is very much moving sideways. This can actually be used to your advantage when you're utilizing Bollinger Bands within your trading strategy. If you are looking to trade major pairs, such as Euro dollar or pound dollar, then you would only really want to utilize Bollinger Bands in low liquidity months, such as August or December and January, of when most bankers are away and not at their desks trading. We're going to come down to the 15 minutes, and you can see actually just how choppy this really is over the last few days. Now let's design and build a strategy that utilizes John Bollinger's indicator known as Bollinger Bands. So we're now going to add that on to our chart. So we're going to go up to Insert, Indicators, Trend, Bollinger Bands. We're just going to use the default settings here of period of 20. So it means it's going to take into account 20 bars and a deviation of 2. And we're going to have the style as white because my background is black. So let's just chuck that on. Okay, so now we've got the bands put onto the chart. So let's analyze this slightly more in detail. So now you can see that we've got the Bollinger Bands here on the chart on the 15-minute time frame. You can see how we have the lower band here. We also have the middle, which is the moving average, and then we also have the upper band. So we have the two different standard deviations here of our lower band and upper band. Now there's multiple ways that you can utilize this. You can ultimately see that when price is trading at the lows of the band, it is seen as this could be a potential point to rebound back to the average and also reject the highs back down to the average as well. So how we want to utilize this, or how I think that it can be best utilized, is again, just like we did in our previous Sunday video, we have two moving averages, which you can see here. In this case, the 50 and 200 moving average. So you can actually see that the short-term downwards market is in play. We have our short-term moving average below our long-term moving average, meaning that the overall sentiment on this current time frame is to the downside. Now we do know that looking at the daily, because of the pair's correlation between the two currencies, it is very much range bound anyway. So one of the ways that we can effectively trade this, we can utilize again the fact that short-term momentum is to the downside. So in this case, it's almost more probable for your trades to win if you're taking short trades only if you're doing it in line with the trend. Now, trading range-bound markets can be difficult, and that is why I've ultimately already said you should be focusing around August, December and January, which is a prime time that's coming up right about now as we go into the Christmas month. So how would I tackle this on a 15-minute time frame? Now, there's two ways that you can do this. Ultimately, if we're looking at our entries and where we place them, in this scenario here, we would be looking to take short positions from the upper band. So if it touches the upper band, and looking to either on a conservative level, exit back at the average, or exit at the low extreme, which you can see comes down here. So ultimately, if we was to analyze where are the areas that price has pierced, we can see one here. You can see it's touched the bottom and rebounded back up to the average here. You can see it did it again here. And you can see it did it again here. It also did it again here. And again down here. So you can see there's plenty of times. You can see it touches just there. You can see plenty of times where this is constantly happening. So you could be very busy if you was trading this on an intraday level. But making sure that your trades win is the tough part when you're using the likes of Bollinger Bands, because ultimately these moves may not be big enough to excite you. For example, so you can see here that because we're on such a low time frame, you can see that actually the price increments from moving from high to the average is only 7 to 8 pips. If you're to go all the way to the other side, it's 16 pips. So in this case, because of how the pair is moving, it is very choppy, and ultimately there isn't that much in pips level to be able to take from the market in this case. However, a basic understanding here can see if I was to sell at the high, either exit at the average or exit on the extremity, is the basics behind Bollinger Bands. Now, the larger we move this to a bigger time frame, the more opportunities that we could potentially see. So now we're going to look at this from an hourly chart and see what opportunities we can see here. We know the currency pair is highly range bound, so let's see what opportunities we can highlight. So all I'm going to do now is I'm going to draw potential entry points from the upper and lower band. You can see on the chart here that the 50 is above the 200, meaning that on the hourly, it may be more favorable to take buys in this range bound market. Okay, so you can see now how we've highlighted all of these different areas of potential interest of where the market has touched either the lower band or the upper band. Now we want to really discuss and break down what could our risk management be behind utilizing this as a strategy. So we now want to look at how the correlation is of the pairs, which we've done. We can see that these are two very closely tied economies, and therefore the market should be very range bound as a rule of thumb. Increased amounts of range bound activity during quiet months, December, January and August. And now we want to understand of how we can tackle that. So ultimately we want to be looking more at the buy side if you're to be more picky on this. And it's just about your exit and your risk management criteria. So if we have a look here on the left, you can see actually how we had a spike literally touch the bottom. You could have potentially exited here in the middle or at the reverse entry level here. Again, you could have gone short again as soon as it came back into the bands, exited potentially at the middle, or look to exit at one of the spikes on the lower band. You could have then bought again and got out on the higher band, and then look to have shorted again and got out at the average or lower band. And again, overall the strategy here looks very, very straightforward. But I can tell you, in a trending market, this strategy would absolutely destroy you. In a range bound market, it's absolutely fantastic for doing that. Now, here are some ways that I've managed to reduce my risk and make sure that overall I am profiting from the markets. So you have two ways of trading this. If you're a complete beginner, you can do it from a perspective of using distance of the bands in itself as your stop loss. So this one here would have been 37 pip stop loss as an example. So you would have entered in on the low of the spike and you would have had your stop loss 37 pips outside of this low. So you would have had your stop loss all the way down here, allowing you to achieve the 1-to-1 if it hits the upper band, or exiting at the middle, which would have given you roughly 0.5% gain. The downside to doing that is obviously it means that you need to win 75% of your trades if you're only risking 1% for a 0.5% gain. If you're targeting the opposite side and you're achieving a 1-to-1, then you have to win at least half of your trades. So you can see how the risk metrics are completely different. The other way of doing it is as follows. So stop loss option 1 is you measure the distance between the low of the band to the high of the band. That would be what I would call your conservative stop loss. Okay, so it's the same distance as the entire band. Your aggressive stop loss would be measuring from here to the average. So you can see that your stop loss would therefore be halved. So you would have a much tighter stop loss, but this would then increase your reward to risk potential and overall risk management. So you have to weigh out that factor. Would you prefer to get stopped out less and have a potential 1-to-1 or 0.5-to-1 reward to risk? Or would you prefer to get stopped out more and doubling your potential reward from these positions? That is ultimately how I would trade this from a risk management perspective. Depending on your taste, is the conservative or aggressive? It's completely down to you. But this is one of the basics of using Bollinger Bands. It's also a great tool to be able to highlight extremities within the market from the lower band and the upper band, and utilizing standard deviation within your trading strategy. So overall, we've covered how you can trade this from the reversion to mean perspective, but also from a trend perspective as well. If you agree with me that the 50 above the 200 is one of your filter factors, it means that you would only be taking buys from the lower standard deviation on the extremities and trading it back to the average or back to the higher band. So that is one way that you can filter out potential entries to stop yourself from getting stopped out on those short positions going against the trend. What are the benefits of using Bollinger Bands within your Forex trading? It's great for highlighting lower levels and higher levels of extremities and potential interest points for getting into the market. It's a great way for calculating what is the average movement in the markets for stop loss placement, so you can use the distance of the bands from lower to upper bands to be able to use your stop loss placement. And it also shows you where is the current average price if you was interested in exiting one of your trades. Now, those are pros to using Bollinger Bands. The downside to using Bollinger Bands are the simple fact that the markets do not always range. This allows them to be vulnerable to shifts within market news. So if you have a strong news announcement coming out, fundamental news, you'll find that the bands are completely made redundant because it won't even respect the technicals of what is average pricing. And then also in the trending market, it would also continue moving to one side, and ultimately you would even be getting stopped out if you're trading both ways. So potentially using that filter system that I said about trading with the direction of the moving averages can help with that. But there are downsides to this, and ultimately let's not forget that this indicator was made within the 1980s, and the markets have overall developed a lot in the last 40 plus years. So guys, I really hope you enjoyed my explanation of how you could potentially utilize Bollinger Bands within your Forex trading strategy, highlighted the advantages of using it, also the disadvantages of using it. If you like this video about Forex strategies and you would like to see more of them, make sure you hit that like and subscribe button and get in the comments if you utilize Bollinger Bands in your trading strategy.